The Nasdaq 100 started the week gapping up overnight on Sunday, which was filled the following day. This is the second week in a row where major indices have gapped up on open over the weekend, highlighting the uncertainty in the market at the moment. We saw price end last week near the lows, just above the key technical moving averages, with traders not willing to hold into the weekend after tensions remained high between Israel and Gaza. The market likely gapped up overnight on Sunday in relief more than anything, as there were no further escalations over the weekend. At the moment, the market is likely to overreact in either direction, and that can lead to gaps. It is important to manage position sizing when there is uncertainty like this. While the gap filled on Monday and held the key technical moving averages as shown in the daily chart, Tuesday saw price edge lower, driven by weakness in Nvidia, after the US tightened export controls on AI chips to China, which hit Nvidia stock and dented the Nasdaq 100. Price did retest, but more importantly, remained above the key technical moving averages. This chart here shows how 7 stocks have led the performance of the S&P 500, of which Nvidia is one of them. The so-called Magnificent Seven now reflects a record 29.7% of the entire index by market cap. This is up from 20% at the start of the year and above the 29.1% high in 2021. Meanwhile, the remaining 493 stocks in the S&P 500 are currently up just 3% year to date. Why am I showing you this chart? If these big 7 names start to underperform, the whole index will roll over. So it's worth keeping an eye on these 7 stocks on the watch list. Wednesday saw further selling in chip stocks, particularly AMD and Nvidia, as a result of Tuesday's news with the US tightening restrictions on the sale of AI chips to China. This weighed on the Nasdaq 100, but the ongoing concern remains bond yields, and the 10-year yield on Wednesday breached 4.9% for the first time since 2007. The rise in yields is spooking investors, as borrowing costs continue to rise, with the average rate of a 30-year rate mortgage in the US hitting 8%, the highest level since mid-2000s. This saw price break back below the key technical moving averages, which held on Monday and Tuesday. You can see on Thursday price went back to retest the moving averages as resistance before sharply reversing. The trigger? Fed Chair Powell's comments that inflation is far too high and would likely require lower economic growth. That saw yields continue to rise. The 10-year got very close to 5% on Powell's comments, and the Nasdaq 100 whipsawed before eventually selling off. Tesla reported earnings on Wednesday after the close, which missed analyst estimates, and that hit the stock, further weighing on the Nasdaq 100. CEO Elon Musk warned about higher rates would likely reduce demand for EVs, and that the company's Cybertruck will not produce positive cash flow for more than a year after production starts. Now, the ugly candlestick which produced an inverse hammer yesterday was an invitation for further selling, and today we're fast approaching the weekly trendline in red, with the 10-year crossing 5% yield for the first time in 16 years. The incentive to own stocks over bonds is diminishing. In terms of levels to watch into the close and next week, we're edging closer to the weekly trendline in red, which is held for a month now. This is why we saw the rebound of this trendline last week. But the more this trend gets hit and tested, the likelihood of a breakdown increases. The weekly trend is around 14,500. Below that, and we have the lows from the last couple of weeks at 14,420. Then we have 14,290 and 14,080. On the upside, 14,780 and the key technical moving averages around 14,980 will act as resistance. Next week we have more tech earnings with Alphabet, Meta, Microsoft and Amazon all reporting. And we also have US Q3 GDP, so that'll be the focus. With that said, thanks for watching. Remember to hit that subscribe button so you don't miss out on future content. And I'll see you at the next one.